waiting. Hello? Thanks so much for that insightful and exciting discussion on the latest trends in fintech that are out there. So now we've got a topic that's actually really close to my heart. I used to live in Asia for 11 years. And when you start looking at the investment that's taking place around the world in fintech, out of the 23 billion that was invested last year, 11 billion of that came from the Asian region, and obviously China is a massive part of that. We sit here at the intersection between Asia and Europe, and so we're going to see a lot of influence in this region that's going to come from the West and the East. And so without further ado, we're going to invite Ronit Ghosh up here from Citi, from Reseach, to tell us why China is dominating fintech in the world.
Thank you. Thank you to the organizers for inviting me. Good morning, ladies and gentlemen. So I'm going to talk a little bit about the way the fintech global map looks today. One of the topics I'm going to talk about in the next 20 minutes is, as the introducer said, why does China dominate? What factors came together? What was in the menu or the recipe that allowed China to become this enormous player in fintech? I'm also going to, as we talk through, look at applicability of the Chinese experience to other transition economies, emerging markets, and hopefully I'll try to draw out some relevant comments for Dubai and the UAE and the GCC as well. So let's start with a short definition of fintech so we're all on the same page. There's a hell of a lot of things that get called fintech these days, so it's worth just maybe defining what we're talking about. What is fintech? I don't know how old you think I am, but when I left India as a child in 1985, pretty much no one had a phone. I don't know if people know the numbers, but in 1985, about 1% of the population of India had a phone, a landline. When I checked just before this presentation, something like 900 million people have mobile connectivity. So when I think about fintech in countries like China, in India, for me, a core part of the definition of what fintech is about finance driven by the mobile revolution. You can throw in big data, analytics, social media, but ultimately it comes out of the mobile revolution. And layered onto the mobile revolution, and I'll talk about this in a bit, is the e-commerce revolution. Those are, for me, the fundamental pillars on what we call fintech is built, particularly B2C fintech. So where is fintech? So we talk about what is fintech, so where is fintech? Fintech at the moment is talked at conferences like this all over the world. But when you look at actual investments by companies or financial institutions or venture capitalists, when you look at the dollars invested, fintech is really about two parts of the world at the moment. Pretty much everywhere else it's talk. At some point this talk might become walk, but right now it's really about two parts of the world. It's about the US and it's about China. If you look at the top pie charts, last year between the US and China, 80% plus of fintech investments went into just those two markets. And when you're looking at growth, year-on-year growth in China, it was up 64% last year. So not only is it about two parts of the world, it's really only one part of the world where fintech investments grew last year. Now this is a calendar year 2016. If I take Q1 17, the picture looks slightly different. There's actually quite a resurgence in Europe, specifically Germany and the UK. Brexit doesn't seem to have affected fintech investments in the UK. So Europe's kind of been quite strong in the first quarter. Instead of 10% of fintech investments, which is what it was in 2016, Europe's running at about 20-25%, which is near its natural share. Its natural share should be about 1/3. And where the UK and Germany, London, Berlin, Frankfurt's been particularly strong is in B2B. If China has led the way in B2C where the opportunities, particularly from Europe and the US, I think the opportunities you're going to see is going to be in B2B. Some of the biggest fintech players, I'll just put up on the page there. On the previous panel, they talked about, will there be a unicorn in fintech in the GCC or in the region? Right now, there are quite a few unicorns. Most of them are concentrated. We took $2 billion just to make the map look a little bit easier. They're really concentrated in the US and China. There's one in India, obviously fueled by demonetization. Paytm. Paytm really had a WhatsApp moment in India last year in Q4. Tremendous growth. And there's a couple in Europe. In terms of products, where does the money go? It really goes into lending. If you're looking at investing in fintech, 60% of the fintech investments last year globally went into lending. And there's a really good reason why lending dominates fintech. That's where banks make money. If you look at the bank revenue pool, think about where banks make money globally, something like 50 to 60% of the banking revenue pool comes out of lending products. So it's not surprising that a lot of fintech investments go into lending, despite the well-publicized problems that some of the quoted fintech lenders had in the US. And that's what's led to this very strong growth in insurance investment last year, which looks so far a bit like a one-off, hasn't followed through this year. But once you get outside the US experience of last year and you look at what's happening in countries in Europe, in the emerging markets, it's still very much lending driven. And in emerging markets, there's a huge opportunity in lending because of the ability to use alternative data, to get away from using historical data and using something more predictive. In cities as well, where there's a transient population, so this is a very good example of it, Dubai, but also in cities like London, New York, where there's a large population that doesn't have an established credit history in the city, using fintech and alternative analytics is a great business opportunity. Now just to delve into a little bit of the experience of what happened in China and whether or not the experience of China, there are fintech companies that are privately valued at $20 billion, $40 billion, $60 billion in last funding rounds. Could the experience of China be replicated? And I'm just going to run you through some of the factors, socioeconomic and technological, that we think drove the real growth that we've seen and that's led to China dominating fintech. The first thing that happened in China was that you had a new digital middle class emerge at the same time as the smartphone revolution. If you look at fintech adoption rates in the UK, in the US, the problem is most consumers already have an established way of doing business, whether it's on payments. So for the US consumer, they're very much part of the Visa, MasterCard, Amex ecosystem. Taking them out, the friction costs are significant. But when you have a new middle class emerge, which is what's happened in China, you create huge new opportunities. Just to run through some of the numbers you can see on the right-hand side of that chart. These are sort of definitions of middle-class populations. So if you go to 2002, so 5 years before the iPhone is brought in, only about 9% of the Chinese population counted as middle class by local definitions. 9%. In 2012, which is 5 years after the smartphone, you're looking at significantly higher numbers. You're looking at almost 70%. So just around that technological change, you get a social revolution. And so that's why in emerging markets, whether it's in what's happened in China, what's happening in Southeast Asia, what's happening in urban India, could be happening in the GCC as well if the regulatory environment is appropriate. You need that background, that socioeconomic background to change. You also need, and this is for me, I think a crucial factor, you need a strong e-commerce market. And it's questionable whether or not the region, and at the moment I don't think we have it yet. Obviously there's been some notable transactions you're all aware of in the UAE. But what really powered the growth of fintech in China was e-commerce. Because where fintech first emerges, the money goes into lending eventually. But at the start, it gets driven by payments, and it comes out of e-commerce payments. And so if you can create, I mean, if you're the MAS in Singapore, or if you're the authorities in the UAE, and you're looking to create a fintech ecosystem, it's not enough just to have incubators and hives. You need to have, I think, an e-commerce infrastructure as well. Why did new entrants, why did technology companies drive change in China? It's partly because the financial institutions were asleep. If you look at this map, what I've looked at here is smartphone penetration as a simple proxy of technology adoption. And you can see smartphone penetration in China is similar to Sweden, the US, UK. But look at the banks. The banks in China were institutions and are institutions. The banks in China have balance sheets that aren't consumer driven, that aren't retail driven. The banks in China have balance sheets that are wholesale driven. And this is a classic case, whether you look at China, whether you look at the state banks in India, often the banks in this region in Africa, it's very easy to make money doing big ticket loans to governments, to large public institutions, wealthy families. It's risky to deal with the consumer. There are high costs of servicing the mass market consumer. So what happens is that when you get the e-commerce revolution in emerging markets, most of the incumbents aren't prepared. They're not ready to deal with this change because they're not consumer companies to start with. They're corporate companies, they're institutions. So that's why we think in the bottom right-hand quadrant, if you're in a country like China, in a lot of emerging markets, where you've got a digital society, but the banks are unsophisticated, you're going to see significant new entrants, often e-commerce companies, social media companies, tech companies, driving financial innovation. If you're in the upper top right-hand quadrant, where the existing incumbents are already consumer companies, and the gentleman that introduced me works at MasterCard. MasterCard is a consumer company. Citi has been, or these parts of Citi have been, a consumer company for 40 years. Within these US, UK institutions, there's a very strong consumer DNA. So a lot of innovation actually will be driven by the card operators, the existing traditional players, not so much just the newcomers, the new incumbents. So fintech, what is fintech will vary tremendously by what part of the world you're in. Now, another interesting factor that happened in China was when China started out by saying, we're just going to copy what Yahoo is doing, or we're going to copy what the US internet companies are doing 10, 15 years ago. But the business models that the Chinese fintech companies have built has gone way beyond being just copycats. And they've gone to a stage where actually now you've got the Western internet companies, whether it's the GAFAs, the Facebooks, the Googles, the WhatsApps, wondering, how can we replicate what's happened in China? Is it possible from a regulatory perspective to replicate what's happened in China? And I threw out regulation a couple of times in my presentation because regulation is really important. The Chinese authorities took a regulation-light approach. They allowed a lot of development, just to can let 1,000 flowers bloom, so to speak, and then see what happens, and then try to regulate. And so you've got this unbelievable innovation that's taken place in business models more so than technology. There's not a hell of a lot that the Chinese have done on technology that you could say is truly innovative. QR codes, etc., not truly innovative. But in business models, there's been a lot of innovation. They've gone, coming out of payments, they've gone rapidly across the whole financial spectrum, into mutual funds, into lending, into credit scoring from alternative analytics. And that's been, I think, one of their real advantages. Now, looking ahead, just very briefly, a bit of crystal ball gazing. What do we think will happen in 17, 18? Where does the global fintech map look? One key focus is going to be in the B2B space. So far, a lot of fintech has been in B2C. And the reason is, where does the fintech money come from? A lot of it comes from either US VCs who are used to B2C plays, or it comes from internet companies, social media companies, again, consumer companies. What you're beginning to see, and you saw this come through a lot last year, is traditional financial institutions, banks, card operators, insurers, putting a lot of money into fintech. And so naturally, when they're putting the money into fintech, what are they thinking about? How do I re-engineer my business? How do I save costs? How do I reduce the costs of production, distribution, and also, very importantly, compliance? One of the questions for the previous panel from the floor was, one of the discussion points was headcount. How many of us will be in this room going forward in 3 to 5 years? And it's an old saying, you know, we always underestimate change in the short term, but we overestimate change in the short term, but underestimate change in the long term. Because when you think on a 10-year horizon, forget 3 years, on a 10-year horizon, the number of jobs in the industry, the number of physical outlets in the industry will be fundamentally different. It may not happen in 3 years in London or Dubai, but in a 10-year view, there will be significant changes. And there already has been. If you take the frontier or the cutting edge of fintech adoption in traditional institutions, it's happened in Scandinavia. And if you look at if you see the top right-hand chart, that's a number of branches per capita in the Nordic region. Now, when I first began looking at banks and working at a bank in the 1990s, we used to have bank robberies. It was a major cost of doing business. It still is in places like, if you're looking in a Nigeria or a Pakistan, security, physical cost of security is huge. Now you hardly get any bank robberies in Sweden because 95% of the branches don't have cash in them. The number of branches has come down significantly in the last couple of years. Just to give you one concrete example, a bank in Norway called DNB, about 2 years ago announced, we're going to shut down half our branches in 1 year. And if you can't get to your branch, driving within half an hour, that's not, that's our client service proposition. As long as you can do it, it's a bit like going to an out-of-town supermarket. That's the kind of idea of having a relationship with a branch. And so what you've seen in somewhere like Norway is that you get about 9 or 10 branches per 100,000 adults now, whereas in the US, the numbers are still about 30. So in Scandinavia, you're running at numbers about 1/3 the US, because they started this journey about 10 years ago, about 2006, 2007. Between 95 and 2005, 2006, nothing happened. There was no change. So if you'd been in that period, and you'd been a consultant or a manager, you'd have been looking at the industry going, we're talking about it. All these guys from McKinsey are coming and telling us the industry is going to change in 2001, but nothing has happened. And nothing did happen until 2006, 2007, and then it hit a tipping point. And then when change began, it really moved rapidly. What drove that change? 2 things: financial pressure, the global financial crisis in 2008, but also technological change, smartphone revolution in 2007. Another major shift going forward is going to be internationalization of the big incumbents in countries like China or emerging markets. I think it's going to be a long time before a GCC-based unicorn goes global, but the Chinese are already going global. And they're going global in 2 ways. One way is following Chinese tourism. So as Chinese shoppers go abroad, that's a natural way to expand, if you're an Alipay, for example. And the other way is through acquisitions. There's been a string of acquisitions, particularly in Southeast Asia, in India, into Paytm, and also now in the US. So the Chinese are going to go international. So in terms of key takeaways for 2017, 2018, number 1, more investments in B2B from B2C. Number 2, this is being driven by banks, and you're going to be seeing significant, we think in developed markets such as Europe and the US, significant re-engineering, restructuring of distribution. Number of employees, number of branches will fall by 1/3 plus in a period of a decade. Could be in some of the more advanced countries even faster. Number 3, the Chinese internationalization. And the last point is watch what's happening in India as the next frontier of scale. And this is a very different model to what's happened in China. It's been very much driven top-down rather than bottom-up. It's been driven through government initiatives, starting with, as many of you will be aware, the Aadhaar biometric ID scheme, all the way to now, most recently, and this is still very nascent, Aadhaar Pay, where you can pay basically from your bank account directly with biometric identification. If you want to follow us and you want to look into some more of what we've done, there are a couple of reports you can find online. You can look us up on our Citi Research portal. You can look us up on LinkedIn. And if I have some time, I'm very happy to take any questions from the floor.
Hi, good morning. Thank you for that. That was very interesting. My name is Gaurav Dhar. I run a payment technology company for about 20 years. We're present in about 16 countries, mainly in the Middle East and North Africa. And we look at technology adoption in these markets from a point of view of what's relevant to the economy. Now, I didn't see much data that you had on Africa, which was relevant on feature phones as opposed to smartphones. Adoption for markets is relevant to market requirements. So perhaps in Nigeria, blockchain or Bitcoin is required because of currency stabilization for remittances, things like that. I didn't see, do you have any more data on that? Or is the data too thin in a fragmented market such as the Middle East, GCC, and North Africa to actually corroborate changes that are going to be affected by either the demographic itself or by technology? Because adopting technology for the sake of technology is not relevant. It doesn't work. You can't force feed it to happen because the adoption rates are so fragmented, especially in ecosystems which are very transient in nature, which have huge churn rates around the core of a stable population. So looking at the data sets that would make technology adoption relevant to these regions, what are you seeing in those trends? Because looking at India, looking at China, looking at the USA, those market demographics don't apply here. So I'm curious to know what your thoughts are on that.
Yeah, it's a really good question, particularly thinking about it from a UAE perspective, because everything I said was if you have technology adoption, smartphone adoption in China really drove e-commerce, and then to fill that last mile, e-payments developed, driven by e-commerce companies and then social media companies. And then off the back of that, because regulators took a light touch initially, or intentionally or not, that allowed this whole ecosystem to grow. And in a way, when you look at sort of the GCC, you have obviously some of the highest rates of smartphone adoption, some of the highest rates of Twitter usage, social media usage in the region. But what you're lacking is that e-commerce culture, which is not a cash-on-delivery e-commerce culture. So there's still too much. I've been based in Citi in Dubai now for a year, and I'm still staggered by how much cash gets used in the economy, and that's one of the fundamental problems of payment companies trying to grow in this region. I'm out of time. The organizers are waving at me, so maybe we can follow this up sort of bilaterally. As I said, my details are up there. If you do want to connect with me, please contact me directly. I'm sorry I can't take more questions. Thank you for listening.
Well, did everybody get all those numbers written down? There's just a few of them on there with some pretty amazing charts. And as you can see, while it's happening in China, it's happening in the US, it's happening in the Nordic. When we talk about what's going to happen here, it's how are we going to do it here? Maybe a little bit different, but it's an inevitable path. And I guess one of the things that we're seeing in this region is the banking innovation that's happening in MENA. So we've all seen the consolidation that's taking place, and we've seen a couple of new digital banks launch in this market, and there's a new couple of challenger banks that are launching in this market, as well as some innovation in insurance, as well as lending, etc. So I'd like to welcome to the stage Tony Graham, who's a former country manager from Arab Bank and a Next Money ambassador and member. So welcome, Tony, for the panel on banking innovation.
Yeah. Sure, absolutely.
Is this? Oh yes, we're on now. Thank you, Aaron. Good morning, ladies and gentlemen. Thank you so much for attending. I think we're going to have a lively discussion. We're going to talk about digital banking innovation in MENA. I would like to, rather than me individually introducing the panel, I would like to invite all of the panel on stage, and you can introduce yourselves. So can we please have a round of applause for our distinguished panelists? So Naveed, you're not going to sit under your picture. That's fine. That's fine. Let's start with Naveed. Naveed, could you introduce yourself, please? Oh, I'm sorry, Omar. Excuse me.
My name is Omar Hashim. I come from Saudi Arabia. I'm heading the digital banking in National Commercial Bank. But as well, I sit on a couple of financial industry fintechs. One of them is Souq al-Mal. I sit on their advisory board. And I work closely with the regulator on a lot of payment initiatives and enabling the digital economy within the financial industry.
Okay, great.
Darren Taylor, coming from Clearly, we're a new proposition to the region and to the world. So what we're trying to do is bring a whole new way of banking to the UAE and build out from there. You'll hear a lot more about our proposition as we go through. I'm the Chief Design Officer for Clearly.
My name is Jayesh Patel. I head up Emirates NBD's new digital bank, Live, that's targeted towards millennial customers.
Hi, Craig Moore. I'm the CEO and founder of Beehive. Beehive is an SME lending platform for SMEs within the UAE, and we're the first regulated peer-to-peer regulator, first peer-to-peer regulated entity in the MENA region.
Hi, my name is Naveed Minhas. I head up banking for Middle East Africa, focused on working with clients, where we work on how do we acquire and retain more and more customers. It's all about customers.
Very good. Thank you, gentlemen. And I'm Tony Graham. I was a career banker. I now call myself a recovering banker. I was in banking for 17 years in 9 countries, and now I'm the managing director of experience training, and we help senior executives become better presenters and public speakers. Right. Let's get right into this, gentlemen. Digital adaptation in the GCC is no longer an issue. We're well over 75%. Digital platforms are gaining importance. Many, many banks are doing many, many different activities, investing a lot of money, and yet digital banking here, arguably in the GCC, is somewhat behind where other more developed markets might be. For example, Europe, North America, even the Far East. I guess my first question is, why in 2017 are we only at this point? Why has innovation in the digital space taken so long? And I'll open up the floor to anyone who would like to respond to that first.
You're absolutely right. I think today the penetration levels we see within Saudi out of the banking industry is far beyond what we see as penetration in our own digital banking. I think there are few challenges that we have took with us through the years, driven about regulation. I think regulation is a big key disabler to the growth we see. A lot of, I would say, limitations for us to develop services, whether to serve the clients or to acquire them, that would require their physical presence. So I think this is challenge number one. I think from an investment perspective, today most of the investments that are done by the bank are sanctioned by the board, are very much focused on clear business cases that would require to see the line of efficiency or revenue growth immediate and not something that you'd invest into the future. But with that said, in the last 2 years, we're beginning to see within the financial industry in Saudi inflection points. So what we saw till probably 2015, that the growth rate within the digital penetrations in the industry was far below what we saw in other industries. So we're far below the Western countries. I think at 2015, and as an industry, I'm not talking as a bank, the inflection point we saw is bringing an unprecedented growth that is creating a lot of excitement, realism to the investments that we're making in digital banking. So in a sense, the last 2 years, there is a change that we feel, that we have realized, that is creating a lot of change to our core strategies around digital banking.
What's driving that? Is that customer preference? Is it cost, the need for cost management of banks? What's behind that?
I think it's both. Today, our biggest cost is 2 things in banks. Number one, the cost of human capital, and in a retail banking, the cost of the FTEs in the branches is the biggest cost, and the cost of the physical outlets for you to require customers, you require physical outlets, and you require FTEs in that. Today, our digital play has been about efficiency. But on the other side, the client are looking for the convenience, are looking for the servicing without going to the branch. So I think it's these two momentums are driving this adaptation rates. And we're beginning to see that some banks in Saudi are seeing the lower end of Western Europe penetrations.
Right. Gentlemen, who else would like to add to this?
Yeah, I think it's an interesting question. So when you think about it, the way that you framed it was, why are we seeing it now? It's been around for some time. I think when you start to take a look outside of the UAE and across, let's say, Europe and the US, I think that they're still fairly early on in their growth as well in terms of digital. So all banks, pretty much, you can go across the UAE, you can go across and you will see they have mobile apps, they have internet banking. What runs behind that is still very manual. It's driven by lots of people and lots of process. I think what you'll find is the early adopters, the ones that have pushed forward in this market, have put a very good front end, and some of them have some strong infrastructure in different regions. So the US, for example, has perfect infrastructure to put a front end on top of, and you get the likes of Movin, Simple, etc. So I think that the infrastructure has been in place in Europe and in the US. But when you start to look at what's happening, and I'll go on to the UK specifically, it's still very early on. You've got 4 clear leaders in terms of who's trying to push the challenger bank market, but they're all very early. You've got 2 of those banks that are just now launching, and 2 that have been in the market as a prepaid card proposition, so if we look at Monzo. And that's where you start to see these are people who have started their journey at how do we build from the ground up and actually transform customer experience. And the whole premise of what they're built on is how do we ensure that customers get real value, they get faster and better services, and they're using a modern bank that's built for today's needs, and it's built on a new architecture as opposed to the legacy systems that exist. So I think that when we relay that back to the UAE, I think that we're at the stage where we've realized that you can build very good digital front ends. I think there's very few players who have taken on the challenge, clearly being one of them, that actually focus on how do we go from the ground up and really build the core banking platform that is built for the future.
So a digital front end and a paper back end.
Correct.
Now, is that what Clearly is trying to address? Maybe you can, because you have quite a unique business model. You're sort of a hybrid of an IT provider and an actual and a business and a bank.
So we really, whilst we bring the technology, we're not the IT provider in that sense. So if I'll give you a quick oversight of what we're trying to achieve. Effectively, Clearly is looking to build the world's best banking experience, and we're looking to do that without ever becoming a bank. How do we do that? We partner with existing retail banks, and we do that because that allows us to do a couple of things. One, it gives us the regulatory coverage that we'll need. It also allows us to cover things like trust of an existing bank. We believe retail banks are still very trustworthy, and you know that your money's safe when it's being banked in a retail bank. What Clearly does, which is different, is we do build the full technology stack. And that means that we allow a single integration into our partner bank. We run the service, we run the full customer experience, we service everything from the customer's needs, we provide the products. And we do that, and we bring that to the bank, and we give it to the bank for free. We're not asking our partner banks to buy something from us, we're just asking them to believe in our model. And we're saying, if we partner with you, we're going to give you the opportunity to own a huge amount of that profit share in conjunction with us, and we'll move that forward. So we're going to continually grow and invest in our platform to ensure that it remains profitable. You make a one-time decision with us, which says we're going to partner with these guys, and we'll bring you a whole new customer acquisition model and a whole new brand.
So effectively, we will make you as a bank digitally relevant, and therefore relevant for the future, in exchange for sharing your customers and your revenue.
Yeah, we're not sharing customers. We will start with 0 customers. We're not looking to take their existing customers. We're looking to bring a whole new proposition to the market.
Okay.
And we're building that all around the customer experience. We're ensuring that you get access to all the products that you would expect, but we deliver them in such a different way. And the way, let me give an example of a loan product. We will ensure that when you need a loan or you need a credit card, you understand what you're pre-approved for. We're not looking for you to apply, provide us a huge amount of data that we can then go back and run checks. We will come back instantly. You will know at that given point that you're pre-approved, and we'll move forward from there. So we onboard you, we collect data on you, we understand what we can do with you and what we can lend you, and you will always be able to get that instantly. So that's very different from going through a legacy platform where when you apply, it's still going to take time.
What's been the response? I just want to explore this a bit more. What's been the response of banks?
It's been incredibly surprising. So
Say again?
Surprising. So our going-in hypothesis is that we would have to fight tooth and nail to find our partner bank, and the reverse has actually been true. We are in a point where we're in due diligence with a number of banks, and we're at the point where we can actually look at that and say, who is the best partner for us? And when we make that choice, we're actually looking at the people who are sitting on the other side of the table and understanding if they believe in our vision and they want to move forward and deliver in the way that we believe is most beneficial to the customer.
Now, just moving down the panel, Jayesh, conveniently located next to you, Darren. Jayesh, you're the head of Liv, and Liv is the digital bank for ENBD. So ENBD has taken a different approach. You've decided to build the infrastructure in-house.
So what we've done is we've looked at our customer segment for the past few years and tried to identify within the changing millennial segment, we see behaviors being different. We believe it's no longer just about banking. Banks need to go further, so they need to focus on the consumer lifestyles. So we've developed a proposition which takes a balance of lifestyle and banking. And we try to integrate the two seamlessly so that you can live an effective lifestyle you want and still be financially healthy. Yep. So that's our proposition. The way we've structured it is we've used some of the technologies that we have that are reliable and proven, and we'll continue to use those. In the areas that we can innovate, we've gone out and innovated, either built it ourselves, or actually partnered with a lot of local startups to some homegrown ideas to integrate within our system, and some global fintechs. Yeah? So we have a hybrid model where we use our core, but then we bring in services from other partners, and some we develop ourselves.
So is Liv, is it a new business, a new revenue stream opportunity for ENBD, or is it just a new channel to serve existing customers in a much more efficient way?
It's a new business. It's a whole new business which looks at not just acquiring customers, so we acquire customers from scratch. We don't take Emirates NBD customers by default, so we acquire customers by scratch. We change our operating model to be more digital, so we don't use existing processes. We design new processes that are digital for us, and we have a different revenue model. Yeah? So we are also tweaking our revenue model to see what are other ways in which we can make it more attractive for the customer. Yep.
So one of the challenges that challenger banks have dealt with elsewhere in the world is customer acquisition. The funny thing about banks is, people love to complain about their bank, don't they? Don't they, bankers?
Yeah.
People love to hate their banks, and yet they don't leave their banks because the banks make them feel safe. And challenger banks come with a name, with a brand position that no one's heard of, and when you're talking about my money, well, that's not a leap that I take lightly. Now, Craig, maybe you can speak to that experience with Beehive. So, relatively new. You've been in the market now for what, sort of 4 years now?
2.5 years.
2.5. Oh, pardon me. Okay, so 2.5 years. You offer investors the opportunity to lend to support the SME market, but it's a new name. What's been your experience in that regard?
Yeah, no, I think it's a very valid point. If I look back maybe 3 years ago, one of the biggest challenges that we faced when we launched was actually educating the market. Right? So I certainly had a preconception that as a proposition it would be picked up quicker people would understand it easier. But actually, we had to spend a lot of time and obviously marketing dollars in terms of educating the market. And I think that's one of the challenges whenever you're bringing new propositions to new markets. You can't underestimate the time it will take for people to get comfortable with the brand, comfortable with the proposition. And there's also a degree of osmosis. You can't force the market. You know, people need to be talking to each other at barbecues and you know, coffee shops and saying, oh, I've been on Beehive, I tried Beehive, I know a guy that's taken finance over Beehive. And that osmosis is what lifts it up over time. So I think education is particularly important, and I think that will be one of the challenges for any new proposition when it comes to customer acquisition, is trying to make sure that people understand not only your business model, but what you stand for. So in the way that Jayesh talks about Live, I guess, aiming more at the millennial side of their audience, then for us, we had two customers, if you like. We had the SMEs on one side who needed to understand what we were. We weren't an equity play. This was them taking finance in the same way they take finance from their bank. So we had to educate the SMEs and get them comfortable with the process, which was an accelerated process, but also the investors. So we've recently become regulated, but before we became regulated, all our liquidity came from retail investors, so people like in the audience. And again, when you're engaging with retail investors, there's a huge education process. They've got to feel comfortable. They've got to feel comfortable about where their monies are going, the control of that monies, et cetera, et cetera. So, I think whenever you're doing anything at the front end, it's the iceberg above the water, but actually it's the back end processes, the back end things that need to make the regulators comfortable, that it's sometimes easy to underestimate. We've had to spend a lot of time and energy and effort and money making sure that we can package all that together.
So you're effectively trying to get customers to change their the way they save money. So instead of putting in a bank account, they can invest in SME. So you're trying to get them to accept a new brand name in the market, a new channel for doing that, a digital channel, and accept SME risk.
Yes. So you're trying to open an asset class that previously, the banks serviced, and part of that education as well is telling people you wouldn't put your life savings on a peer-to-peer platform. That's not what it's there for.
Of course.